My name is David McKeegan, and I'm with Greenback Expat Tax Services. And I'm here to talk to you today about renouncing U.S. citizenship for covered expats. Now, you're considered a covered expat under the IRS rules if any of the following apply. If your average annual net income for the 5 years ending before the date of your expatriation is above $155,000 for 2013 or $145,000 going back to 2009. So if your average annual income is above those two thresholds, you'll be considered a covered expat. If your net worth is over $2 million on the date of your expatriation, you'll be considered a covered expat. Or if you have not complied with all of your U.S. federal tax obligations for the 5 years before your date of expatriation, you'll be considered a covered expat. So basically, if you haven't been filing your tax returns or complying with the federal tax laws for the 5 years before you renounce your citizenship, you'll be considered a covered expat. Now, if you are a covered expat, then the IRS assumes that all of your property is deemed as sold at fair market value on the day before your expatriation date. And then any gain or loss resulting from that deemed sale is taken into account for the tax year of the deemed sale. So you can owe taxes, basically an exit tax, based on this deemed sale rule. Now, the amount of the gain that is includable in gross income is reduced by an exclusion amount, and the exclusion amount goes up each year according to inflation. For 2013, the exclusion amount is $668,000. Now, any gain above this will be taken into account and taxed by the U.S. government. Now, one of the questions we get a lot is what happens with property, because maybe you're not planning on selling rental property or something like that when you leave. You can defer the payment of mark-to-market property, but there's separate rules around this, and you would need to take this into account. You'd really want to look at this with an accountant if this applies to you. Now, you can also defer the payment on specific tax-deferred accounts, such as IRAs or 401ks. But again, if this impacts you, you'll want to talk to a tax expert to really understand how these rules will apply and what the implications are for you. I hope this helps, and if you have any questions, please let us know. Thank you very much.